I'm delighted, and in our research and our preparation for today, to deliver to you Platform Strategy. I'm a 15-year technology investor, operator, and now financier. After growing technology businesses and managing technology investment funds, we saw the need in Southeast Asia for entrepreneurs to receive financial advisory from like-minded professionals that understand technology, strategy, and Southeast Asia. We cover the region with our team of 8 dedicated advisors based in Singapore. And in our firm's history, we have completed over 40 transactions. Today, we will discuss what is a platform and introduce the platform. We will show you why it's the most powerful business strategy ever created. But most importantly, we'll talk about what does it mean? What application does it have to all of us? And then, questions and answers. Enter the platform. The story of the platform is really actually the story of your life. Less than a generation ago, your parents, if they wanted to have an evening out, and if they lived in Singapore, granted, not all of you grew up in Singapore, you would have used a company, Singtel, to pick up the landline and call up the restaurant. To book, you would go through the newspaper on Straits Times, maybe listen to the radio to find out about the news, see advertisements for things that you want to buy, and listen to music that you might want to buy in a CD form later on. And on your way to dinner, you will stop past a CapitaLand mall, purchase that CD, buy those clothes, and then get a taxi cab. But today, it is completely different. Today, we know that you are more likely to make a booking through Chope, check on Facebook, WeChat, Instagram, to find out about the things that you want to find out about. Listen to music on Spotify or YouTube. You will buy things off Lazada, Taobao, or Carousel rather than walk through a shop and buy it. And even if you walk through those shops, you always check online to see if it's cheaper there anyway. You are not happy in Singapore with looking at all the taxis that are changing shift. And you can't bother trying to flag down that taxi, so you get that Grab instead. And today, you are interacting with at least 5 to 10 platforms on a daily basis. So what is a platform? And let's spend some time here, because a platform is unlike anything we have ever seen. It has 5 elements. A platform facilitates exchange between buyers, sellers, and users within an industry, sector, or vertical. Travel platform, Ctrip. E-commerce sector, Alibaba. In a manner that enhances and maximizes the number of transactions which are designed to be low cost, fast, and frictionless. It takes 15 seconds to book a restaurant on Chope, but 3 to 5 minutes to call up that restaurant, enabling buyer-seller discovery and curation. There is no offline store in the world that can match the availability and the curation of any online shop that provides reliable information within a trusted environment. Now let's talk about exchange, low cost, fast and frictionless, discovery and curation, reliable information, and trusted environment a little bit further. These are fundamental components. Alibaba came to be by first connecting the Chinese businesses to the rest of the world. GoPay is the one-touch on-mobile payments platform for Gojek that is Indonesia's version of Stripe in terms of its payment business. It's low cost, fast, and frictionless. And if you've been to Indonesia, you know what a pain it is holding all those notes, right? Lots of paper, and shuffling through all those coins. And so GoPay is fast and frictionless. Buyer-seller discovery and curation. We talked about Chope. You also look at Hungry Go Where to find out where to go to, what's hot. Reliable information, Ctrip. You trust, you rely that the flights and the hotels available on Ctrip really do exist, that the prices are real, You trust the information that you look up and get from Wikipedia, which leads to the whole environment being trusted. Your parents would tell you to never get into a stranger's car. You, 10 years ago, would never get into a stranger's car. But now, some of you do this on a weekly, if not daily, basis. Thinking about an even more important asset, a home or a property. Who would let someone stay at their property without a deposit and a strong legal contract less than 10 years ago? But that's exactly what all the accommodation providers in Airbnb allow today. Platforms and platform strategy, I urge you, just cannot be ignored. In 2018, out of the top 10 global companies, 7 are platforms. 2 of them from China. And our prediction, more of them to come from this region, from China and India and Southeast Asia. It's useful to have a look at an alternate reclassification of companies when we think about and explore the companies that are platforms. The 20th century linear and supply-driven companies were either asset builders, such as Boeing, building planes, service providers, such as McKinsey, providing consulting, or software providers, such as SAP, in terms of enterprise software. And the striking thing about platforms, when you have a close look at Amazon, Uber, Alibaba, that you should note are the far superior returns and the far superior valuations that they all receive from investors. As investors, you cannot ignore platforms. So, we will discuss why platforms are the most powerful business strategy ever. 1, network effect. And we all intuitively understand this. Tencent, with WeChat, at 1 billion users, is worth more today than ever before, because each additional WeChat user gets to potentially connect with 1 billion other users. And whilst you add users, and you can add them in an additive manner, the number of connections grows in an exponential manner, meaning that as I go from 2 to 5 users and only add 3 users, meanwhile, I've actually created 10 connections. This has reshaped the revenue curve because the exponential growth leads to exponential revenue and revenue achieved at a low or near free marginal cost. And when you look at platform companies and when you think about all these companies making a loss and you think that all the investors are crazy to invest in platforms, and you look at valuations that you simply don't understand or find it hard to understand, consider that investors are willing to take a bigger risk down here to get to here. Platform strength. 2, data. When we looked at big data and tried to decipher through all the hype, we came up with a definition that we like to understand why is big data different. Because the reality is, data has been with us for a very long time. We've always had data. What is different now? We like to think about 3 particular aspects. The sheer volume of data, the sheer speed at which the data is collected, processed, and the variety of data is unlike anything before. It is producing amazing business, medical, social insight, spawning artificial intelligence, machine learning, and deep learning. It is expanding the human and machine collaboration. People argue, can humans beat machines? Can machines beat humans? But you know what? That is the wrong question. What people need to care about is whether they need to stop focusing on that question and focus more on the superior results generated by human and machine collaboration. And let me demonstrate. The Medallion Fund was founded in 1988 by hiring only math scientists and using data with no Wall Street bankers. Not only did it beat the S&P in its history, but for the last 25 years, it generated an annual return of at least 25%. And you can see in many years, some of those returns have neared 100% per annum. And if you think that the jury is still out, no. The argument has been won. Nothing beats the collaboration, the intelligent collaboration between humankind, machine, using data. Speed. It took 50 years for Walmart to generate $500 million in revenue. Uncle Jack with Alibaba did it in 16, 3 times faster than Walmart. And in the process, in 2016, became the world's largest retailer. The speed in which platforms are achieving growth and dominance has simply not been seen before. Platform strength, multi-channel monetization. Platforms have flexibility in who they charge and how they make money. By being able to keep their services low cost, free, or even negative cost, they can keep their network of users addicted. When it costs you nothing to join on Facebook, but it costs you not being connected to your friends if you do not join, you are going to be addicted to the platform. When people give you money to use that platform, Shopback, you will do it, particularly if it's easy. Tencent, Facebook, and Google are all free to a set of users. And as Zuckerberg explained to the Senate committee in the US recently, we sell ads. Now, there's a saying that I quite enjoy. If something is free to you, you know what? Most likely, you are the product. Because what Tencent, Facebook, and Google are selling back to their real customers is your attention and your data. Let's make no mistake about it. The last platform strength we will discuss in this presentation, open innovation and value add. Why do people pay so much for an iPhone? We all know that Apple makes tremendous profits out of an iPhone. And arguably, Xiaomi, Samsung make a much better phone. So why do we spend money on this Apple iPhone? I'll tell you why. Complementary products. An iPhone without iOS is useless, worthless, absolutely worthless. You pay the money to get onto the iPhone so that you can use Facebook, Twitter, Instagram, Skype, WhatsApp, Line, Kakao, Naver, wherever you're from, whatever you're interested in. You pay for this product to get the complementary products for free. And because it is the Apple ecosystem that has been open to third-party developers, note, none of these applications were developed by Apple. They've provided a gateway of limitless open innovation and value add. There are other forms of open innovation and value add, but one that I like is producer participants. Now, we talked about Airbnb doesn't own its hotels or its accommodation options. But what about the wonderful range of accommodation choices you can find that is growing every day? And the amazing amount of choices to suit the most amazing variety of users. Not all of us want to stay in 5-star luxury resorts. Some of us want something very different. Some of us, or all of us, have different needs throughout different stages. And having producers provide value to the platform independently of the platform itself, unlocks choice, innovation, and value add. And of course, as an investment platform. Now, in China, more than half of VC funding is from strategic companies. And we all are aware that Baidu, Alibaba, Tencent dominate the investment scene in China. And when you talk to some of the most prestigious and successful funds in China, such as GGV, what they will tell you is that they are always balancing whether to take this investment for the strategic benefit versus taking investment from a pure financial player. Platforms themselves are reshaping the investment landscape in terms of having strategic investment come in earlier and earlier in the life cycle of companies. And there's simply too many other platform strengths to talk about here. So what does this all mean? Where are we now? We are at an amazing place. If you look at the confluence in the development of the human race, the growth of the population, the quality of life, and our use of technology, you are able to see 4 distinct stages. The Stone Age was about controlling the physical environment, which ensured our survival. The Industrial Age leveraged the human body. Internet Age leveraged on the human mind. And for us, we feel that we are here at the end of the first internet age and just at the beginning of the second, where we will see human and machine, machine-to-machine connections, autonomous vehicle, data, and increasing capital flow. When I talk about capital, I just don't mean money. I mean technology capital, I mean talent capital, and what we're finding increasingly now, social and political capital. And if we look at the evolution of business strategy, in the industrial age, it was all about production. How do you make it better or cheaper? As we went towards globalization, post-World War II, and into the internet age, we talk about Porter's 5 forces, blue ocean strategy. With the adoption of the cloud, we saw software as a service, internet as a service, and of course, we looked at Boston Consulting's group cash flow model and M&A investment as a key pillar of executing corporate strategy. Now, we are in the era of platform strategy. So what has allowed all this? I mean, what has actually happened? 3 things: connectivity, big data, and rising income. By the time the decade is over, there will be 3 billion smartphone users. There has been more data created in the past 2 years than in the entire previous history of humankind, Forbes. And in one of the most celebrated achievements in recent times, we will have another 2 billion people join the ranks of the middle class in 15 years. So with connectivity, big data, and rising income, we've seen the creation of 114 platform unicorns in less than 20 years. And for those of you that aren't familiar with the term, a unicorn is any company that's valued at $1 billion or more. And so what does this mean globally? Perhaps, and I invite you to change thinking. You no longer need to have factories, hotels, cars, planes even, to participate and be a successful player in the modern economy. Unlike the monopolies of the 20th century, modern monopolies are required to provide value. Users are dedicated to platforms that provide value. Was Facebook the first social network platform? Absolutely. There was Friendster and MySpace. And Friendster and MySpace did not control the quality of users, the quality of user interaction, and stopped providing value, which paved the way for Facebook, which was not first, but eventually became the most dominant social network platform. And the war is on, and the battleground is Southeast Asia. Because if we think about Facebook's competitor, is it Twitter? Nope. Maybe it's Tencent. Does Facebook provide payments? But Tencent does. So the war is on, because to keep your attention and to keep you, they need to completely, continuously provide value. This is unlike the previous monopolies of the 20th century. It was all about owning the infrastructure. Platforms have fewer limitations, so you'll see them grow faster and grow to new areas of the world regionally, which touched upon this. We have a rising economic trend and an infrastructure that just can't keep up. Even more exciting, here in Southeast Asia, we see complete creation and leapfrogging. We are mobile first. We may skip credit cards altogether. So we have Ant Financial in China with cashless payments, lending. We have Paytm in India, which has done the same. We will see the same in Southeast Asia. And this explains why outside of North America, Asia has more platforms than you'd expect in Europe or the rest of the world. But look, what does this really mean to us? What does it mean to each and every one of you? We suggest 3 things. You invest in platform companies. $5,000 in Amazon 20 years ago is worth $2.5 million now. You work for platform companies or work for investors that are involved with platform companies. The average revenue per employee for platform companies is 2 times more than any other type of company. And you use some of the thinking around platform strategy to navigate what the future would look like. Uber, Airbnb, Grab are less than 10 years old because we encourage you to invest, work, and use the framework to navigate, because platforms, in our opinion, are simply rewriting the business rules for the 21st century.
So we actually wanted to understand more on the evaluation, the major techniques and methodologies, and especially VCs and PEs, and major assumptions during evaluation, like for the practical issues. If you can talk a little about that.
Yes, I can. So the reality of early stage valuation is simply liquidity and negotiation. It's a myth that it's about certain benchmarks or certain valuation science. The reality is you get hot markets where there are thematics that investors are looking for. You get situations where there are not a lot of the right companies for investors to look for, but they have a mandate from their GPs, LPs, to go after that type of company. And the reality is at that early stage, it's simple. You just pay more for people that you like in terms of talent. You pay more for ideas that you like. And when you reach the investment world, where you're competing with other investors for deals, you'll just simply pay a bit more to make sure that you don't miss out. For example, you don't want to be the investor that missed out on Alibaba, Baidu, and you'll pay a bit more just for that, as you get a little bit more developed in terms of a company life cycle. Because of all these different monetization methods, the way we look at the financial statement is completely different. And of course, one of the key ways that you look at valuation of these new technology companies is, of course, the revenue multiplier. But within that, we talk about number of users. Within that, we evaluate the quality of those users. How many of those users are you getting? How much are those users are staying on your platform? And how are you making money from the user? So we see a lot of platforms which have attracted users purely through subsidization, but haven't been able to make money elsewhere. That's not a valuable platform. We've seen other platforms, of course, which can attract users and at the same time make money either from the users or from other sources. That is valuable. So as you look into these platforms, look at users, and in particular, I'd encourage 4 things: user acquisition, user lifetime, user profitability, and user scale. Stickiness. The churn.
Many of these unicorns, platform-based unicorns, they are from China, possibly because China has this big population base. So to have this strategy, probably it's not so easy to be a platform in Singapore, given that maybe you're constrained by the population size. So I think this is rather a country level or economy level strategy instead of individual company level strategy.
Yeah, that's a great question. And what makes us very excited about Singapore is, for us, we see Singapore as a de facto headquarters for Southeast Asia. And Singapore has its own unicorns. So we have Grab, which everyone knows about, that's operating in multiple markets, in multiple segments, mobility, payments. We have Razer, which exited. And I saw Ming yesterday. And Razer is known as a hardware company, but few people know of it as a software company that's also bundled up now with payments and using online gamer currency. So that is a platform that's come out of Singapore and launched in global markets. And of course, there was another one, which used to be known by Garena, otherwise called SEA, which exited on the New York Stock Exchange. And so Singapore as in itself has a totally insignificant, in the scheme of things, total addressable market. But as a headquarter, as a base for talent and capital to expand around the region, it's quite an exciting place.
So do you think Singapore is leveraging more from the Southeast Asia market, or given that majority here are ethnically Chinese and speak Chinese, and actually that's a bigger platform for Singaporean companies to get into the Chinese market or the East Asian market in general?
Yes, that's a great question. China is a bigger market. There's absolutely no doubt about it. And it's exciting to look at it from there. But as investors, we need to consider return and risk. And so let's think about risk. The level of innovation and level of competition is just not anywhere near that in China yet. So if you have a great idea, does it potentially make more sense to look at the regional markets where there's less competition, there's less risk, and the cost of capital potentially is lower because you're getting a premium for that higher growth? Because as investors, we need to be rational as well. We can't just think of what's exciting, what's the biggest market. And so what we're finding is that a lot of smart money is thinking that China is exciting, but the easier opportunities are gone, and that there's a better risk-adjusted return from thinking about Southeast Asia instead.
Probably language is also an issue, right? Here I think people speak reasonably better English, and maybe it's easier for foreign investors to communicate. Whereas in China, of course, now more and more people speak English, but still all these dominant platforms, they are operating in Chinese. And Baidu, I don't use Baidu to search for English articles, right?
Yes.
Jingdong, all these are more like local-based platforms. And luckily, China has a big local base.
Yes.
So, on the other hand, is to some extent maybe constrained by the language and the culture.
Yes.
Yeah, that's the benefit of Southeast Asia.
Absolutely. And what we're actually seeing in China and in Southeast Asia is a merging. So again, in China, we're seeing close cooperation with Western companies. We obviously see very close cooperation with Indian companies via the likes of Paytm. We see in Southeast Asia the influence of China, the influence of the US and Western style, together with own local factors, which is quite interesting. And in the next 10 to 20 years, you will see a breakdown of these barriers. You'll see, as we mentioned previously, more capital flow of all types.
So before I turn on to someone else, I want to pick up one point on your slide. So 20 years ago, if you invest in Amazon, it's $5,000. Now you got 2 point something million.
Yes,
But that's assuming you invest 20 years ago. Right?
correct.
And Amazon 20 years ago is different from Amazon today. And now today we are already at this age, and we probably shouldn't expect same kind of exponential growth in the next 20 years, like keep on investing in Amazon or other platform companies.
Sure.
Yeah. So from the investor's perspective, I don't know. Of course, if you look at the past return, this is always hindsight, right? That's I don't know, going for future. Maybe new things come up after 10 years, and then maybe people no longer talk about this.
Absolutely. So the first thing I will tell you is that the number one thing you should definitely do is not ignore the lessons of Amazon and not ignore what's happening to investing in traditional companies. And as investors, your job is to look at maximizing return from various alternate investment classes and alternate investments. So the study of Amazon is very important. Secondly, what I'd say is that it at least gives you some idea of what success looks like. So you can look for not the next Amazon, but look for the next elements of what makes a successful platform or a dominant business. Look at businesses which are growing users exponentially, but yet finding ways of monetization.
Okay. So any other questions from the class?
Like recently, like you mentioned Paytm several times and MobiKwik. So especially like in India now, the RBI, Reserve Bank of India, last year they came out with a mandate that every mobile wallet platform would have to comply with the Know Your Customer (KYC) norms. Now, especially in India, with so much of rural population, these companies, they're facing major problems now to call on the customers and to get their documents and to comply with this. So I read an article yesterday, in fact, only that mobile digital payments and mobile payments have reduced by 85 to 90% now. Moving ahead, there's a major challenge in all these, like you mentioned about integration of Facebook. Now Facebook is also coming out with, digital payments and those things. So what do you think, would be the challenges in India regarding this particular thing? And can you give few other relative challenges, in markets like China or the US, just for comparison?
Thank you for your question. So I spoke to Vijay a couple of months ago, and he's very aware of this issue. And that's where, when we look at platforms, we look at the convergence of some enabling factors. And we mentioned big data and AI is one of them. And when you look at economies like India, or even if you look at economies like Indonesia and the way that China developed, there's no such thing as detailed records of people, right? Traditional credit scoring, right? What you had in China is a development of automatic big data credit scoring. And so you're looking at, in India, the use of alternate ways of getting the data to actually satisfy KYC. And what we're seeing now on the verge is, of course, blockchain, right? To actually look at the integrity of that ledger, to look at, how can it be secure and trustable. In fact, I might just move away from Southeast Asia or Asia and talk about one of the potential use cases that's very relevant right now. And that's actually, would you believe, Syria. So they're very worried about what's going to happen in Syria. They're very worried about any potential change in regime, any potential flight of people. And when people come back to Syria, if they do, their residual claims on any property assets they had, of any of their own personal records, which is the idea of where, even when there's no central government per se that you're sure about, you can actually have a record, and a trusted and immutable record. So we'll see big data, blockchain, a lot of these solutions help out. In terms of why I'm fairly bullish about Southeast Asia, is that I believe in Southeast Asia and even India, there's a pragmatism. There's a very big pragmatism to adopt these technologies. For one, you're looking at a lot of cash economies. And if you think back about original economics, cash moves quite slowly. And so it's actually quite an economic problem in terms of security, risk, but also the velocity of money. And so a lot of these governments, as long as they can control it, would love for their citizens to have cashless because they have more information about their citizens, and that more easily lends its way to lending. And when you have a look at ultimately what's important to these economies, it's economic growth and jobs, and providing lending to the small to medium enterprises is absolutely critical. So there's a huge social element which I think is really helping push the regulators in trying to make them understand and be pragmatic around some of these platform companies and technologies. And when you even look at Facebook and what's happening recently, do you guys know the number of people that are killed in car accidents each year? It's 1.5 million. Globally, right? But are we going to stop the car industry? No. Every single innovation, for it to succeed, has obviously had a value that far outweighs the impact or negative impact. And what we believe in the case of Facebook is that we're not going to have 1.5 billion users abandon it overnight.
Other questions?
Hi, Mr.
Yeah.
I have a question about the internet bubble. Do you think there's an internet bubble in the near future, like in the world? Because for now, like in China, there are many new startups like OFO, and these companies, as far as I know, they don't make money yet. Like you just said, it took Jingdong 15 years to make a profit. So let's say if one day the investors don't have a faith in the internet companies anymore, and they stop to provide their funds to these companies, or the interest is too high, the cost of the funds is too high, and these companies cannot fund anymore, so they're going to collapse one by one. So do you think there's going to be this condition in the future, or because I think people now is too positive about the internet companies, and once the companies have something to do with like the international finance and Bitcoin, and their stock price are going to be very high. So I think I'm just wondering, going to be a bubble in the near future.
I will not comment about whether there is a bubble now or in the future. What I will comment about is certainly there are things that are different this time, but equally there are valuations that we don't understand. And we're not sitting here and going to pretend that we understand all the valuations up there, particularly when the monetization models are just simply unclear. And what we saw is everyone get onto the bandwagon about things that they don't understand with 2000, and we see that with Bitcoin, and we see that with a lot of the internet companies of today. We certainly do. We sift through that, and we believe that if there is a bubble, and if there will be a bubble, that'll actually be very healthy. If you look at the internet champions of today, they were born out of the bubble and bust, right? They went through it. It's good cleansing of the system, and I would actually encourage, if there was a bubble, that's a great time to go in and invest. So what's different about today, I think, is very important to talk about. And for us, there's a few factors that you should really look at. And that's one, is that anything that provides value to the user while simultaneously being able to monetize in some way, shape, or form. So if you have a strong user base that is just addicted to your platform and a way to make money off it, and you have a sustainable scale where you're a clear market leader, that's a company that shouldn't be ignored. The other thing around the internet economy this time around is that there are a lot of socioeconomic factors that are different. In 2000, it wasn't considered that China would be the second or even the most largest economy right now, right? And what people didn't think about in the traditional internet bubble was how would the internet translate in emerging or developing markets? And with the speed of software and processing and the availability of data, that's creating very different economic models for internet companies. That's completely different from the late 1990s and the late 2000s. Also, if you study the internet bubble of the past, and in fact all previous bubbles, what you see is that the price increase is caused by the sheer wave of investors, professional or not. And what we've seen is the emergence of very large internet investors that have a very long-term view. We thought that the IPO of Alibaba was big at $25 billion. And then SoftBank came out with a $90 billion fund. And you know, people now talk about, rather than IPOing, they'll go for the SoftBank round. And when you see so much money with such a long-term investment horizon from very sophisticated investors away from the public market, it actually provides a bit of a floor for some of these valuations. It's a great question.
If I may follow up on that, since you mentioned that you don't want to comment on business that you are not sure about their valuation, actually I'm going to push a little bit forward on this.
Okay.
For you to push back. For example, this Ofo Mobike, this bike sharing companies in China. I think they are fundamentally different from Uber, Grab, Airbnb. They all call themselves sharing economy companies. But Ofo and Mobike, they are not really leveraging on, so they have their platform. They also have a lot of capital expenditure by making those bikes, whereas Grab does not make cars, right? Airbnb does not build apartments. So in this sense, I think they are fundamentally different companies, although they all leverage on certain platforms. And to me, I'm much less optimistic about the sharing economy business with a lot of capital expenditure. So I mean, personally, I'm not super excited about their valuation, although they keep on receiving new rounds of money. I don't know whether you have any comments on that, or you want to.
We've definitely got comments, and we've looked at bike sharing extensively, and that's a great case in point. So we had the number 3 bike sharing company in China collapse, and then a couple of months later, as we're all feeling, a bit question mark about the whole bike sharing, we had the acquisition by Meituan, right, of bike sharing platform, and that's given investors new hope in the bike sharing business. Question mark of how you monetize bike sharing, I agree. But you can't ignore that the utility of providing those bike shares to the users, the data from those users is very attractive to some of those platforms. And the value of anything, you've got to remember, is not necessarily a result of an artificial or scientific construct. The value of any business or company today is what someone will pay for it, right? And as long as there's buyers, there is a price and ultimately a valuation. The other thing is, we see bike sharing as a very developing markets phenomenon. There's a couple of things that are different that's happening socially, politically, and then the developing markets. One is that we're actually impressed, and I know you do some work around CSR and sustainable growth. We're very impressed by Chinese stance, and obviously it's taking an opportunity to show leadership in the world markets by looking at how do they grow their economy in a sustainable and more green manner. And even if we look at the demographic shifts, it's less about ownership of assets and more about sharing. So it's very much in the social, economic and political thinking of our times. In fact, if you look at US car ownership amongst the millennials, there's evidence that points to millennials now are buying 10% less cars than they did 10 years ago, right? So it's quite interesting. And then if you look at the physical environment, right, for bike sharing, we talked about how the infrastructure isn't keeping up. We talk about how even if you look at the US and the development of the US infrastructure, it was all built around the automobile industry. And so with the denser populations in China and the emerging markets, we see that bikes are more relevant in terms of fixing that last mile transportation issue. There's something like 30 plus cities in China with a population over 1 million. So we see that very much the urban economics combined with the social and political factors make bike sharing quite an interesting phenomenon to us.
During Series A, like for example, you as a venture capitalist, you would want to value a company. So now, since we don't have any public comps, because it's not a public listed company, it's a startup or it might be just a growing company. So there's one challenge there, how to value that. Secondly, since at the very beginning, it's very difficult to forecast, assuming on the growth rate and the discount factor, especially discount factor. Again, it's a very big discussion. How do we come to so all these challenges are there. So we would want to know that what is the valuation model? How do we go about that? Valuing a company where you don't have comparables. There's a great challenge in forecasting. So do we really try to forecast the intrinsic value of the company at that time to calculate the post-money valuation, all those things? That's first thing. And second thing, I wanted to know that Northridge, since you are a VC investor, so we keep hearing that there is a great deal of percentage of failures in investments, but you try to look for those 1-2 unicorns. Now, so what is in reality, what is the percentage failure rate? I mean, at Northridge when you invest, so I'm like, isn't it very risky? And what's like, is it actually 99% which people say you fail and 1% you really make money on a big company? So.
That's a great question. So, okay, I mean, let's start with a couple of approaches. You've got 500 startups and they will clearly tell you they don't know what works. They just know what failure looks like. And so their way of investing is to just make multiple bets on companies that they feel do not necessarily fit in the bucket of what failure looks like, right? And they hope quite well that, someone will succeed. And what they're banking on is the alpha that they can produce, right? In terms of their network, in terms of coaching of the entrepreneurs, in terms of having so many different bets. So that's one approach. And valuation, again, it just comes down to a negotiation. And if I was able to give you a calculator for valuation, I would, but it simply doesn't exist. Then you hop on to Series A and Series B, and that's when you start to talk about benchmarking some valuation elements, looking at what the future like, and that's definitely where you look at public comps. But what you see in the emergence of the last 5 to 10 years, now all of us I think are very familiar with Bloomberg and Thomson Reuters. Who is familiar with CB Insights? PitchBook. Traction. So the issue of all the private company valuation data has given spawn to all these big data AI information services that try to scour the internet and give as much information as possible on these private companies, right? Because there is this big, dark gap in information on private company valuation, etc., right? But going back to Series A and Series B, again, and with what the more experienced investors, they will look at from their history and from their learned history. And obviously, nothing beats the investors in the States and now coming to the investors in the Chinese. And we have a lot of investors from the Chinese and the States in Singapore and regionally now. They basically know or have a feel for what success looks like and what they'll pay for it in terms of Series A and B. And in terms of failure rate, 1 out of 10, 1 out of 5. The truth is that yes, there's some benchmarks, but every VC, every PE company takes this differently. And there's so many risks to look at. There's been a shift even to PE type investors. PE type investors have shifted now. We've felt a shift in the last 18 months from we don't invest in technology, it's all a bubble and we can't understand it, to if we do not invest and if we do not consider investment returns from technology companies, we will miss out. And so we've even seen traditional PE players lower their check sizes, lower their requirement for profitability. And not only traditional PE players, but family offices, high net worth families. Now, most of us from Asian heritage, and we understand that the first thing we do when we save money is buy a house, right? You just buy a house. That's what you do. You don't put it in the stock market, you buy a house, right? but we're seeing a shift. We're seeing a shift, and we're seeing a big shift towards the greater risk and balancing between the greater risk of, look, if we do not invest, if we do not try to learn, what is the opportunity cost of not being a participant in the new economy?
Yes, Robin.
Yeah, I have a question on maybe exit strategies of investing in such industries. So compared to maybe real estate or typical SME private equity deals, what are the advantages or challenges in exit strategies in platform deals?
Sure. So one of the big disadvantages and something that's developing is the lack of public markets in the region. And we see that Hong Kong is obviously making great strides to try to bring the Chinese companies back. Singapore is doing wonderful work around education. And the ASX in Australia, being the 6th largest stock exchange in the world, is obviously doing its part in terms of providing that funding and that exit mechanism. But that's definitely one of the challenges. There is actually a lack of public markets. And then if you did want to go to the US or NASDAQ, you have to be a pretty big story. You have to be a pretty well-developed story. And so it's a very hard hurdle to get an exit via the US market. So that's one of the challenges that we're facing in this time. But what we're seeing is actually quite exciting. And in our business, when we help our clients exit, what we're seeing is 3 types of players in terms of acquirers. In an old style business, let's say if you're a car manufacturer, in an old style business, who you would exit to was most likely another car manufacturer. In the new economy, if you are a platform, who you will exit to, let's say if you're Airbnb and there was someone that could pay for you, who would you exit to is maybe a hotel group that you're annoying. It's maybe another internet platform altogether that's not in the hotel space. Or it could even be a large financial investor. And so what you're seeing with these new economy type of companies is different pools of investors, strategic investors, crossover investors, financial investors, and that we see as providing a real jump in liquidity over and above the gap in the ability to IPO regionally.
Or you are seeking some career advice? So one of my undergrad students, Lisa, is now doing internship in this company. Although I heard that he was not doing well in the office. Yeah, I think for those of you, if you're thinking about joining into this industry, I think it's also a good opportunity to ask Chris.
So key skills basically for career advice, for entry roles,
Yeah.
what are the key skills which are required for venture capital entry in VC's firms? And secondly, is there any good reading material which you would recommend, basically on valuation and strategy?
So I will give a real credit to VC Circle. They do a VCC Circle. They do a lot of great stuff. There's also a valuation group. Used to be called American Appraisers. I forget the name, but
Business appraisers,
yeah, they're very good in terms of the valuation. But what I'd say is this, my best advice is 1, be interested. If you're not interested, that's not going to help you through the hard work of networking, finding out, and getting within yourself the elements to be successful. If you're not interested, it's okay, and it doesn't fit. So decide if you're interested or not, and then have the passion. That passion will help you go out there and talk to people. And only by talking to people will you get connected. When you are connected, you will get information. And when you are connected, you'll be able to bring deals in and have information that help you assess and make a success of those deals. And ultimately, that's what drives success into being a venture capitalist or a private equity investor. Academics, good track record, is only one step. I'd encourage you to think about having the passion to go out there, make the connections, get the information, get the ability to capture deals. Because ultimately, that's what they value, your ability to capture deals, assess them, make them work, and exit them.
So, are there really entry roles for VCs, or you come via IB or other financial analyst or equity analyst role, and then do you get an entry direct right away from after graduation?
The reality is that most entry into VC is through connections. And that's why you need to be passionate. You need to be passionate to beat the streets and hustle. If you don't have that passion, if you don't have the audacity to hustle, you won't get the connection. And what you're betting on is that your CV in a big pile, and you all understand this, will make it through the attention of the VC hiring manager, right? And then you'll be able to make all the hoops of the interview process. I'd encourage you to improve your odds by getting connected and having a look at how the majority of jobs are really filled in the industry.
I guess Chris will still be around for a little while.
Sure.
Maybe you have individual questions, we can also discuss and talk a little bit. Let's give a big applause to Chris again.